Chapter 1. The Premium. Darius is 23 when he signs up for his first insurance policy. He doesn't read the full document. Nobody does. It's 47 pages of language written by lawyers for other lawyers. He scrolls to the bottom, types his name, clicks confirm. $187 a month. Car insurance. Mandatory by law. Not optional. Not a choice. A condition of existing on the road. The money leaves his account on the 1st. Every month. Without fail. He pays rent late twice that year. Misses a phone bill once. But the insurance payment, that one always goes through. Because if it doesn't, he loses his license. The system made sure that one is non-negotiable. He thinks of it as protection, a safety net. His $187 sitting somewhere, waiting, for when something goes wrong. It isn't sitting anywhere. The moment that payment clears, it's already moving. Chapter 2. Where the money goes. Insurance companies are not in the business of protecting you. They are in the business of collecting money and deploying it before you need it back. Your $187 lands in their account. Within days, it is part of a $400 billion investment portfolio, pooled with millions of other premiums and sent into the market. Stocks, bonds, real estate, treasury bills. The insurance company has two revenue streams: the premium you pay and investment income, the return they generate by putting your money to work while you wait. The industry term for your money is float. The money they hold between the moment you pay and the moment, if ever, you claim. The longer they hold it, the more it earns. The less they pay out, the more they keep. Both of those facts live inside every decision the company makes, every policy written, every claim processed, every adjuster dispatched, every appeal denied. Darius doesn't know this. He just knows the first comes around and $187 leaves. Chapter 3. 4 years in. 4 years pass. Darius hasn't filed a single claim. $187 every month for 48 months. $8,976 into a company he has never spoken to. Not once. No call. No letter. No acknowledgement beyond an automated renewal notice every 12 months. They took his money, invested it, generated returns, and paid him nothing. Because nothing went wrong. And that, from their perspective, is the ideal customer. Someone who pays indefinitely and never asks for anything back. Then one Tuesday in November, a car runs a red light. Chapter 4. The claim. The damage is real. The other driver admits fault. There are witnesses, a police report, a photo of the light mid-cycle. The case, as far as Darius can tell, is straightforward. He calls his insurance company for the first time in 4 years. The hold music starts. Transferred 3 times before reaching someone who can open a claim. The claim number arrives by email, a 17-digit reference code that will become the most important number in his life for the next 4 months. An adjuster is assigned, calls once, leaves a voicemail, doesn't call again for 6 days. When they finally speak, the adjuster is polite, measured, asks questions Darius already answered in the initial form, says someone will be in touch. Nobody is in touch for 11 days. Chapter 5. The delay. 3 weeks after the accident, Darius is still in a rental car at $40 a day. His policy covers rentals, up to $30. The difference comes out of his pocket. He didn't read that part of the 47 pages. An independent inspector is scheduled for next Thursday. Next Thursday comes, the inspector doesn't. Rescheduled. Nobody told Darius. He took the morning off work. He finds out when he calls to confirm. He sits in a rental car costing $40 a day and does the math. The accident was not his fault. The claim is legitimate. The police report exists. The witnesses exist. And yet every day that passes is another day the insurance company holds his money
earns returns on it, and pays nothing out. He wonders if this is intentional. He doesn't have enough information yet to know that it is.
Chapter 6. The System. Insurance companies have a term for what they do. Delay, deny, defend. Delay the claim as long as possible. Every day of delay is another day of float, another day of investment income, another day the claimant might give up or settle for less. Deny wherever the policy language allows. 47 pages of language written by lawyers exists specifically to create space for denial. Exclusions, conditions, clauses that mean something different in legal terms than in plain English. Defend in court if necessary. Insurance companies have full-time attorneys whose entire job is to minimize payouts. The average person filing a claim does not. Darius doesn't know this vocabulary yet. He just knows the rental car is $40 a day and nobody is calling him back. Chapter 7. The Offer. 8 weeks after the accident, the insurance company makes an offer. Significantly less than the repair estimate. The adjuster explains, calmly, professionally, that certain damages aren't covered under the terms of the policy. Page 31, Clause 14b. He asks if he can dispute it. He can. Appeals take 4 to 6 weeks. An independent assessment at his own cost. A written appeal within 15 days. He asks what happens if he just accepts. Payment within 5 to 7 business days. He has been in a rental car for 8 weeks. He is tired. He accepts. Chapter 8. The Math. The settlement is $2,400 less than the repair estimate. The rental car cost him $1,120 out of pocket. He took unpaid leave the day the inspector didn't show. 11 weeks of calls, hold music, voicemails, and language he didn't fully understand. He paid $8,976 into this company over 4 years. He received $2,400 less than his damage was worth. Lost $1,120 in rental costs. And 11 weeks of his life. The insurance company, over those same 4 years, generated an estimated $1,500 return on the float from his premiums alone. They made money holding his money, made more money paying him less than he was owed, and did it without breaking a single rule. Chapter 9. The Renewal. 3 months later, the renewal notice arrives. His premium has increased, not because he was at fault, not because he filed frivolously, because he filed at all. A claim on his record, regardless of fault, makes him statistically more likely to file again. The algorithm adjusts. The premium goes up. He calls to ask about the increase. The representative explains, politely, professionally, that premium adjustments after a claim are standard, that he is welcome to shop around. He shops around. Every other company has access to the same claims database. They see the same flag. The rates are similar everywhere. He renews because he has to, because the law requires it, because the system that just paid him less than he was owed and then raised his rates is the only system available. He sets up auto-pay, $214 a month now. Chapter 10. The Truth. Here is what Darius knows now that he didn't know at 23. The insurance company is not a safety net. It is a financial institution that happens to sell safety nets. The premium is not protection money held in reserve. It is capital deployed for return while you wait and hope you never need it. The claim process is not slow because of bureaucracy. It is slow because slow serves the company. Every week of delay is a week of float. Every denied line item is margin. Every exhausted claimant who accepts a low offer is a better outcome than a full payout. None of this is a conspiracy. It is a business model, optimized over 100 years by actuaries and attorneys whose job is to ensure the company pays out less than it takes in, always. The product they sell is peace of mind.
The business they run is capital management. You are the source of the capital. The peace of mind is what they charge you for. Whether you actually get it, that's a different question entirely. Darius is 27 now. He pays $214 a month. The money leaves on the 1st. He doesn't think about where it goes anymore. That's the point.